Are 8% rates coming? The recent jump in bond yields and the upcoming Treasury auctions this week. Hello, members and super savers. I hope you're having a good week. These are the 3 topics that we'll be covering in today's video. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. So, in his most recent letter to shareholders, Jamie Dimon, chairman and CEO of JP Morgan Chase, discussed the possibility of a world where rates hit 8% or more. In his view, there seems to be a large number of persistent inflationary pressures, which may likely continue. All the following factors appear to be inflationary: ongoing fiscal spending, remilitarization of the world, restructuring of global trade, capital needs of the new green economy, and possibly higher energy costs in the future. He goes on to say that we are prepared for a very broad range of interest rates, from 2% to 8% or even more, with equally wide-ranging economic outcomes. Now, this is not to say that an 8% or more rate world will materialize. Jamie Dimon is known as one of the more conservative leaders in the market. He had already warned of a 7% or higher world last year, and clearly this did not happen in 2023. As such, some in the industry are taking his 8% or more warning this time around with a grain of salt. But the way we see it, if Jamie Dimon, who runs the biggest bank in our country, the biggest bank in the world by a margin, if you speak about market capitalization, if Jamie Dimon is worried and prepared for an 8% or more world, that should give us a bit of food for thought as well. And in fact, quite a few of you in our community seem to be preparing for higher rates also. When we ran this recent poll asking whether you were building out your longer-term bond portfolio or holding out for higher rates before you go long, almost half of you said you were holding out for higher rates before you go long. And as many of our Diamond NestEgg fans already know, we've been saying higher for longer for quite some time now. And personally, we also remain mostly on the short end with our fixed income portfolio, with our 4-week and 13-week T-bills still on auto roll. But again, that's us at our age and stage of our financial journey. Bond Masters course, folks, you may remember what we discussed in Module 6 and our best model portfolios by age and stage of your financial journey, to put it all into context. Because as I've always said, if I were a decade or 2 older and or closer to retirement, I'd probably be in this group here, building out my longer-term bond portfolio, or at least part of it, despite my higher for longer thinking. Why? Because the fact of the matter is that no one really knows, and the last thing I would want at the age of 65, 75, or 85 is to wake up one morning and realize that those higher for longer rates may never happen, or that even if they happen, the road there may be longer and bumpier than I had expected or am willing to stomach. That's not to say that if you're older and or closer to retirement or even in retirement that you should now go out and buy all your bonds in one go. That is almost never a good strategy either. Remember, you can dollar cost average into individual bonds at auction or on the secondary market, just like many people do with equity investing. Diversify and don't put all your eggs into one basket, as the saying goes. Bond Masters, folks, please refer back to these videos up here that I've noted for you in the course if you need a refresher on the different bond strategies and decumulation strategies you have in your toolkit for these times of uncertainty. Because uncertainty basically seems to sum up the first half of this decade, or even just this year alone. At the beginning of this month, Federal Reserve Chair Jerome Powell was still sticking to the narrative of 3 rate cuts in 2024. Fast forward to a few weeks later, and on April 16th, Bloomberg wrote that Powell signaled policymakers will wait longer than previously anticipated to cut interest rates following a series of surprisingly high inflation readings. And we discussed the recent resurgence of inflation in this latest video on the projected May I-bond rate as well. In our mind, the key learning for private investors like you and me from Powell's and Diamond's messages over the past year is this: have a plan, but be ready to change that plan if and when needed. Meaning that regardless of which of these groups you might fall into, whatever your current plan is, be ready to change that plan if inflation and interest rate scenarios change over the course of the year, month, or week. Just like we did. We initially had no plans to buy the 5-year tips at last week's auction. But the more analysis we did on the topic for April's Member Live, and the higher real yields rose throughout the month up to the day of the auction, the more our perspective changed, and the more we got interested in the 5-year tips, which is a great segue into the next section of this video. So let's compare Treasury rates at the current time versus the beginning of this year. Here we have all the maturities that the Treasury issues at auction. Here's where rates stand at the time of this taping. And here's where rates were when we started this year on January 2nd. And here you can see the increase in rates over the past few months in black, while anything in red indicates a decrease in rates since the beginning of 2024. As you can see on the short end, rates are a bit down, but the changes are a few basis points only. So we can say they stayed more or less stable, which makes sense given that the Federal Reserve controls rates on the short end, and they have not raised or lowered rates since the July 2023 meeting. The 6-month and 1-year maturities have gone up a bit more, but where things have really moved is with the rates on the medium and longer maturities, as you can see here. In fact, the 2-year T-note even broke across 5% last week after Fed Governor Powell delivered his persistent inflation and delayed rate speech. This breakthrough 5%, though, was very brief, and we're back to just under 5% at the time of this taping. On the same note, investors who purchased at last week's 20-year auction did fairly well, with a high yield of 4.818%. The highest since October of last year. Congratulations to those of you who took part in that auction, because I know some of you did. And also a big congratulations to those of you who took part in last week's 5-year tips auction. Based on the comments we've seen, I know many of you did. This 5-year tips auction fetched a real yield of 2.242% and a coupon of 2.125%. This real yield is the second highest in over 15 years. As I alluded to earlier in this video, we purchased some for our personal portfolio as well, and we're fairly happy with the results. So that was a recap of the jump in bond yields and last week's auctions. Now, let's take a look at what's happening this week, because there are a few upcoming auctions that many of our members and super savers are interested in. So here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see that this week's auctions include the 2-year T-note, the 5-year T-note, and the 7-year T-note, none of which are reopening auctions, meaning that the coupon is still to be determined. There's also the 2-year FRN floating rate note here. And if we add up all the different maturities, this amounts to a total of $418 billion of debt issuance by our government in the coming week. Not a small amount for a single week, but I don't want to digress here. Let's go now to Fidelity to see what their estimates are for the upcoming auctions. Here we see the expected coupon and the expected yield for the 2-year T-note. Here is the expected coupon and the expected yield for the 5-year T-note. And here's the expected coupon and the expected yield for the 7-year T-note. Do keep in mind that these numbers can and generally do change all the way up to the date and time of the auction, and a lot can happen in a few days' time, but at least this gives you a proxy of what market expectations are at the current time. Q1 GDP estimates will be released on the morning of Wednesday, April 25th, the same day as the 7-year T-note auction. So depending on how those numbers come out, they may have some impact on those auction results. Because remember, when you buy at auction, you don't know the exact price you'll be paying or the exact rate that you'll be getting until after the auction takes place. The only thing you do know is that you're generally getting the best price at that moment in time based on the then prevailing market conditions and sentiment, and that you're getting exactly the same price and conditions as the largest bidders, regardless of the size of your personal order. The Fed's favorite inflation measure, PCE, which stands for Personal Consumption Expenditure, will be released later in the week on Friday, April 26th. So this report may impact the Treasury auctions for the week commencing April 28th, rather than the upcoming auctions this week. On that note, who's planning on buying some T-notes at the upcoming week's auctions? And if so, which maturities? Drop a comment below and let the community know. As always, I hope you enjoyed this video and learned something new. And if you did, I'd love to invite you to take a look at this video here on one of our 2 brand new bond courses. And to join us for our next live online Bond Beginners course session with Q&A on Tuesday, April 30th at 6 p.m. Eastern Time. Check out the links below this video for more details on our bond courses and YouTube Super Saver membership to see which is right for you. Also linked below this video is your 15% course coupon code for April. There's still time to save and learn about bond investing. All right, members and super savers, good luck to everyone who's buying at the upcoming auctions this week. And see you again very soon with more brand new wealth building content for your financial journey.